Welcome back. We're with David Burrows. Let's get back to the phones. David, great show so far. Michael in Vancouver. Hey, Michael.
Thanks very much, Anita, for taking my call.
Of course.
And to you as well, David. David, my question is on Alarion. I've been watching you for quite some time, so I don't know if it's 2 or 3 years ago or maybe 5 or 6 years ago that you did recommend Alarion. And I just wondered if your comments are similar to Pembina with the yield over 9% at this point in time. I know you're more of a momentum player, but would this be something that I can get into, maybe just dab a little into and just collect the dividend?
Yeah.
Would you consider the dividend to be safe, or would you consider that there might be more downward pressure on this name? I'll hang up, listen to your response. Thank you very much for taking my call.
Thanks, Michael.
So Michael, you're right. Years ago, we did recommend Alarion, and we had a very significant position as a firm in energy infrastructure companies as fracking became a big thing. And so volume started to grow, and the infrastructure companies went from trading at 6 times earnings to 24, 25 times earnings, because it was going to be a growth industry forever because of fracking. And of course, in the summer of 2014, oil peaked at $160 a barrel. And we run breadth models that track the percentage of stocks within an industry that are performing constructively from a price perspective, right? Uptrend versus downtrend. And the breadth models rolled over, the weaklings started to sell off, and to us, that was time to exit. And of course, since then, the group has been under pressure. There have been some tactical rallies, but really not very much to write home about. All I can say is that while the oil and gas sector remains, and the stocks are cheap and have sold off, you have to be careful, cheap and low are not the same things, have sold off and are trading basically on the lows for the year. I have yet to see any indication of an improvement in breadth. So there's a few companies and the producers like Hess, which is acting better than the group, C&Q, which is acting a little bit better. We have small positions there. But really, energy continues to be a place that is not attracting capital. So we're into tax loss selling, clearly, here midway through November, and that could go on for a little while. So I would wait and see a turn before I put on new energy exposure.
You still have some time.
There is a risk. Here is the risk. And I talked about this over the last 5 years. Energy production became mass manufacturing. With fracking, you drill a hole, you have a 99.8% chance of success. And so with certainty, you can go out and raise capital, right? So any tick up in the price of oil that makes it profitable attracts new capital and new production comes on. So I think that that's a structural headwind still for the industry. I know on lots and lots of measures we'll say these things are super cheap, but until I see a turn, I don't want to put new money to work. We're in a pretty good market.
These
things are not participating. So why put money there now? Wait and see a turn, give up a little off the bottom first, and be prepared. And then I would buy the ones that have acted the best, not the worst, because they will be the first ones to attract capital.
And to your point earlier, when you're talking about the weaker companies falling off the map, there is some consolidation yet to happen significantly, right?
Oh, yeah. And, there is lots of new pipeline capacity in the U.S., whereas in Canada, of course, we have none.
Okay. Thank you for that, David. Let's head over to Ottawa now, the nation's capital, where Don is standing by. Hi, Don.
Thanks, Anita.
You bet.
David, United Technologies has a big year coming up in 2020 with the merger with Raytheon, and then it's splitting off into 3 or 4 sub-companies or sub-units.
Yes.
And what's your outlook for that, or what do you think? Thanks.
Look, as I said earlier, we really like the industrial space. It is a very diverse company, and generally when you break up one of these businesses into the sum of the parts, you wind up with more in your pocket. United Technologies basically trading at relative highs versus the market, so it's been performing well. The sector's performing well. There are catalysts coming forward. I mean, could it pull back $5 or $6 at any time? Yes, no question. But I like the stock. It's got a 2% dividend yield, and it is economically sensitive. So if you believe there is an economic cycle, a reacceleration in front of us, this is one you'd like to own. Just want to touch on one thing. People made a lot of talk about the fact that the inventory to sales ratio, or the amount of inventory sitting in the shelves, is elevated. Now, if you do one thing, if you take out the Boeing jets that are sitting on the ground waiting to be delivered, the U.S. inventory to sales ratio in the system is the lowest in 10 years.
Oh, wow.
So you've got not a lot of inventory sitting out there. You've got very strong job market, strong consumer confidence, and a real move to bring industry to the U.S. So industrial stocks, I think, look pretty attractive given the fact that people left the economy for dead as of 2 months ago. And a reacceleration would be great for a company like United Technologies. And certainly, if China were to pick up, good for them for the elevator business as well.
Yeah, it seems like a lot of the headwinds that were coming down the pipe, especially with respect to trade between the U.S. and China, whatever tweets or headlines we seem to get nowadays, you'll see what, a 50, 100-point hit on the Dow. Nothing like what we saw earlier in this year, which sort of tells folks or tells the street that maybe all this is now priced in.
Well, so, you know, certainly people have had time to look at their supply chains and realign them. And not to say it's not disruptive, it is. But I think that the economy's in actually in pretty good shape, and it has been able to absorb it.
All right, let's get to a FANG stock here. We'll bring in Dave from Toronto. Dave, what's going on?
I wanted to ask about Facebook. What would David think about it? Because it's one of the few stocks that are like trading at a PEG ratio of 1, and its PE of Facebook is like well deserved, and it has a lot of growth, controversial or not. And what would you think of it for a long-term hold? Would you buy it here? Thank you.
Thanks, Dave.
Look, Dave, their business model continues to look extremely resilient. You know, they are dominant in their spaces. You look at the estimates for next year, $9 a share in earnings versus this year about $6.50 is the estimate. So, you know, it's going to be a big year next year. There certainly is regulatory risk, and I think that that's what's held the stock back. But that being said, you know, the fact that while the market's been rallying over the last 3 months, it has the relative price performance versus the market has been improving. So it's outperforming the market in this rally. And so I think it looks quite attractive. I'd buy the stock.
All right, there you go, Dave. From David to break. We'll come back with David Burrows, the President and Chief Investment Strategist at Barometer Capital Management, and more of your phone calls, 1-855-326-6266.